Hi, I'm Lauren. Today we're going to discuss real estate and taxes, so don't go anywhere. Real estate and taxes, it's what everybody's talking about. But here's the fun part. Real estate has its own set of rules in the tax code. And if you know the rules, it can help you save a fortune and keep you from making a bad investment decision. In this video, I'll mostly focus on the exciting part of real estate tax rules, short-term rentals. But first, a little background. Unlike your regular business income, real estate operates under a unique set of rules. A lot of this boils down to something called passive activity loss limitations. For most taxpayers, if your income exceeds $150,000, you're not a real estate professional, not a qualified short-term rental, and the property produces a loss for tax purposes, you actually can't claim that loss. But you don't lose it. It will carry forward until you sell or your situation changes. It's important to understand that a real estate loss on your tax return doesn't always mean you have an actual financial loss. This can be confusing, but that's why we should calculate the potential return on investment and tax savings before you buy. Some people convert their primary residences into rental property, which can open up depreciation deductions, and cost segregation studies on properties allow you to accelerate depreciation, adding large upfront deductions, typically creating a loss for tax purposes. And commercial properties, they have their own advantages and disadvantages like longer depreciation timelines, but potential for tax deferral strategies. There's one caveat to all these rules. It's called the real estate professional status, and it automatically qualifies all of your real estate activity as non-passive. That means you'd be able to take these losses right away. The IRS considers you a real estate professional if you spend over 750 hours annually in real estate trades or businesses, and more than half of your total working hours must be in real estate activities. Typically, realtors, property managers, and real estate investors qualify. But be careful with this status. If you're audited, you will need to show proof of your qualifications. But don't worry, if you don't qualify as a real estate professional, there's one other option to be able to realize your real estate losses. It's called short-term rentals. Why? Because they also have their own set of rules. And if done right, they will change your property from a passive investment to active. The IRS's rule for a property to be considered a short-term rental are properties that are rented out for brief periods, typically averaging 7 days or less per guest stay, but you also need to materially participate in managing the rental. This can be demonstrated by spending over 500 hours on rental activities during the tax year, or performing substantially all the work related to the rental, or participating more than 100 hours, but no one else can exceed your involvement like a property manager. Now your losses will be considered non-passive and dollar for dollar lower your taxable income, saving you tax at your marginal tax rate. For example, if you're in the 25% tax bracket and you have a $10,000 loss through depreciation, major repairs maybe, you would save $2,500 in taxes that year on your short-term rental. In summary, understanding the implications of passive activity loss limitations, short-term rentals, and the real estate professional status is crucial for optimizing your tax strategy. Consulting with a tax professional can help tailor these strategies to your specific situation, helping you decide if you should buy a rental property or not. Thanks for watching.